Hi there, I welcome you again in the third chapter of our discourse on option trading strategy. In the previous chapter, we talked about a strategy of bull call spread, which is used when you have a moderately bullish view in the market. Now, in this chapter, also, we'll talk about another strategy which can be used when you have a moderately bullish view in the market. All the other technical parameters remain the same, but the implementation of strategy is done using the put option. Now, how do you go about implementing this strategy? I'll come straight to that. In this strategy, for starters, you buy one out of money put option. Now, why do you buy first? You always buy first when you want to reduce the margin which is required to sell or write an option. So, for starters, you buy one out of money put option. Now, what is the second leg? In this case, the second leg is that you sell one at the money put option. In the previous chapter of bull call spread, you had bought at the money in call option. In this case, you sell one at the money put option and you buy one out of money call option. So that is how a simple implementation of the strategy of bull put spread works. Now let us see the payoff chart of this strategy and understand more in detail about the strategy. As you can see, again, I am on the website of opstra.definance.com and I choose the option of bull put spread. As I told you, you basically would be writing an at the money put option. So we choose to write say 19,800 because that is at the money strike price. And you feel that the range has been about 150 points on daily basis. So what you do, you take 19,650 put option, you buy that and you sell the strategy on the chart. Now you can see the payoff chart for the strategy. Now that is how a payoff chart looks in this case, and because you've sold, you pocketed 108 points. Because you bought, you paid 59 points. So overall, in this strategy, there is a net inflow at the time of the implementation of the strategy. What is the net inflow? Net inflow is about 50 units, and which is the maximum profit in this strategy. Remember, you are expecting bullishness in the market. So whatever premium you pay or receive, the difference in case of put option will become a maximum profit because you're not expecting the market to come down. If the market comes down, you'll make losses because you can see that you start making losses once the market starts coming down. But the good thing about the strategy is this: even if the views are wrong and the market drastically comes down, your maximum loss is capped in the strategy. And that's a good thing about this strategy of bull put spread. Also, your maximum loss gets capped. But the flip side to that is that even your maximum profit is also capped. Even if your views are right and the market keeps going up, because you are a buyer and writer of put option, your maximum profit potential would also be capped in this strategy. Now in this strategy, the break-even point, that is the point beyond which you start losing money if the market falls, is 19,751. How do we get that? So what you do, you basically take the net inflow of the premium in terms of units. In this case is 49 units. And you subtract that from at the money strike price, which was 19,800 for us. So 19,800 minus 49 comes out to be 19,751. That becomes your break-even point in this strategy of bull put spread. I've also bought a leg. The premium is only 26,000. If you had just sold one option, the premium runs in lakhs, which is why buying a out of money option gives you the cushion in terms of premium. So it can also help you taking multiple lots in this position. If you want to implement this strategy, you can go ahead with multiple lots also. Why so? Because the loss is capped, the profit is capped, and you know what you're getting yourself into. Now, as you can see here, the maximum loss is much more higher as compared to maximum profit. Why so? Because the strategy, we have gone little out of money to buy. If I were to come a little closer to at the money to buy a leg, let us see what is the maximum loss which I have to incur, say 19,700. If I do modify and implement the strategy, then you can see the maximum loss which you'll incur reduces, but which also takes a hit on the maximum profit you can make because the net inflow will be lesser because you're getting closer to at the money to buy an option. That is a simple implementation of the strategy of bull put spread. So in these two chapters, we learned the strategy of bull call spread and bull put spread, which can be used to express your moderately bullish view in the market. Even if your views go wrong also, your maximum loss is capped, and which makes this simple strategy very attractive to buyers who want to go bigger sizes in the market. So that is it from me in this chapter of the bull put spread. In these two chapters, we learned about two strategies of bull call spread and bull put spread, which can be used if you have a moderately bullish view in the market. Now, the good thing about this strategy is this: even if your views go wrong, your maximum loss is capped, which makes it very attractive for traders who want to trade multiple lot position in the market. So in the next chapter, we'll talk about another strategies which can be implemented by traders when they are trading options. We'll also see the payoff using the live demo, and then we'll take it from there. So can't wait to see you there, and I'll see you in the next chapter. Thank you so much.